These are historic times in the stock market. The last few weeks have been a bloodbath, to say the least, with many records broken, particularly on the downside. People are scared right now, not just in the markets, but, well, everybody. What should investors do in times of heightened fear and panic such as this? If you are like me, and you are a long-term investor in stocks, then times like these are when I believe you should look to build up your positions in the highest quality companies you can find. Many investors are realizing just now that their investments carried a lot more risk than they were actually comfortable with. It is at times like these that I believe you should double down on the best stocks out there. Some stocks very rarely go on sale due to the quality of their business models, their consistency, and their growth. Companies like this usually trade at premiums, and until quite recently, many were trading at arguably ridiculous valuations. In this video, I want to lay out 3 stocks that I believe represent extremely safe companies for the long term that will continue to grow and thrive in virtually any economic situation. Companies that will shrug off this short term, even if it goes for 3 to 6 months, a year, 2 years, whatever happens in the next year or two, these companies will be able to survive it. The first stock I want to talk about is Costco Wholesale, ticker symbol COST. Now, as you can see, Costco has held up incredibly well over the last month. It's currently trading barely 11% off the highs compared to the S&P, which is down about 32%. Now, Costco has been in the news a fair amount lately, and it's pretty obvious why their stock is performing so well in the current market environment. Competitors like Walmart are also performing relatively well, and the consumer defensive sector as a whole has outperformed the broader market. But this stock has actually been one of my favorites for a long time, but I've never been able to bring myself to buy it due to their usually premium valuation. And right now is no exception. They're currently trading at more than 33.5 times trailing earnings, and average analyst estimates put their forward 2020 PE at 32.78, and their 2021 PE at 30.41. In my opinion, this stock is still very pricey at current levels, but I suspect we might see further downside in this stock over the coming months. If the current health situation continues to escalate, as it looks likely to, even companies like Costco should eventually feel some impacts. In a true market capitulation, all-out selling frenzy, I think quality companies like Costco will absolutely sell off with the broader markets. Conversely, if the stock market bottoms out and people start rotating into riskier assets, Costco might end up selling off in a rotational trade. There are still definite potential downside risks to Costco's business here in the short term that could potentially lead to further downside. For example, supply chain issues, or employees getting sick and refusing to come to work, or being unable to come to work. A massive warehouse with thousands of people coming in and out every day isn't exactly the ideal situation to prevent the spread of viruses. All that being said, I still think this stock is likely to continue to massively outperform the market in the short term. There are so many things to like about this stock, and sell-offs are historically extremely rare. Not to mention the specific advantages Costco has over most other businesses, many of which need to completely or nearly completely shut down during the current health crisis. So what makes Costco stock special? Not only does Costco have a super safe business model, but they're also consistently growing in basically every relevant metric. Costco has consistently grown revenue, profits, free cash flow, and same-store sales growth at high single-digit to mid-double-digit rates. Even more impressive, they've grown their number of warehouses every single year since at least 2005, even through the Great Recession, which was also the only year during that period that their revenue and profits saw a slight decline year over year. While this is certainly not a super high growth company, this is an extremely safe business with consistently above average historical growth. Costco's membership model provides them with a huge moat and is a very safe and reliably increasing stream of income. Pretty much all of their net income comes straight from membership fees, meaning they can afford to keep prices lower than competitors and further build up brand loyalty with their customer base. And brand loyalty is already very high. Membership renewal rates are around 90% per year, and I would expect this trend to more or less hold in a recession, since people will always need to buy the basic necessities, and Costco is able to provide them at very affordable prices. Costco offers a variety of consumer staples like food and health and hygiene products and even gasoline, products that people need every day regardless of economic conditions in our modern world. Costco also pays a very small dividend with a current yield of only around 0.9%. However, their dividend growth history is excellent, having grown the dividend every single year since they started paying it in 2004, with a compound annual growth rate of 14.35%. This dividend is extremely well covered by both earnings and free cash flow, with a current payout ratio of less than 30%. Costco definitely has tons of room to grow this dividend into the future. They have also paid out 3 huge special dividends over the last 8 years, but personally I am not expecting this to become a regular occurrence, and I don't think holding this stock just for the hope of more special dividends would be a good idea. Lastly, even in an extremely unlikely worst-case scenario, Costco still has an excellent balance sheet and a stellar credit rating. Costco would absolutely be able to get financing from investors or banks for whatever they needed, if they needed it. Now, as I said, Costco is still pretty overvalued in my opinion. Ideally, I would like to buy this stock around 180, but I'll take what I can get, and if it gets around the 240 range, I would be willing to start a position. If it got under 200, I would start adding much more heavily. The next stock I want to talk about is much more popular. It's Microsoft, ticker symbol MSFT. Microsoft is currently the highest valued company on the US stock market, and the only company left with a market cap over $1 trillion. Like Costco, I think Microsoft is still probably a little overvalued. But unlike with Costco, I've actually started to accumulate this one. I feel this stock is a little bit of a better value. Microsoft is currently down around 28% off its highs, just slightly outperforming the broader market over that time period. But in my opinion, it was absolutely priced for perfection before this market sell-off started, so even though it's corrected, it's not really on sale yet. You can really see that in the 1-year performance still being up 16.5%. Still, I'm willing to pay a bit of a premium for a company of Microsoft's caliber, so I'm comfortable starting to add at these levels. Currently, Microsoft is trading at a trailing PE of 23.7, with a forward 2020 PE of 24.07 and a 2021 PE of 21.72. As you can see, analysts actually expect Microsoft's earnings per share to decline slightly this year compared to 2019, but their business is extremely well positioned to survive pretty much anything in the short term and continue to thrive into the future. This business is obviously stellar in any kind of normal economic environment, with massive and growing free cash flow, fat margins, and dominant positions in multiple high-growth industries. But really, it's pretty obvious to most people that Microsoft will perform well in the good times. But not only that, they're arguably one of the safest companies in the world, in my opinion. Realistically, their earnings are unlikely to get hit too hard this year, but they could definitely miss analyst expectations if this economic shutdown lasts long enough to start having a major impact on their high-growth business-to-business segments, like Azure, which is their cloud product. Regardless, Microsoft should be able to weather pretty much any storm just fine. Microsoft is one of only 2 companies left in the US with a AAA credit rating, the other being Johnson & Johnson. This means that their debt is rated more safe than US government treasuries. Their balance sheet is basically impeccable, up there with the best in the world like Google. They're currently sitting on almost $134 billion in cash. Even if Microsoft somehow made $0 for the next year, they would be able to cover all their expenses and still have half their cash left over. With all the companies needing bailouts these days, this is a rare thing to find. And on top of all that, they also pay a very safe but relatively small dividend, yielding just under 1.5% right now. Still better than Costco though. They've grown that dividend every single year since they started paying it in 2003, and have maintained a very respectable compound annual growth rate of 12.21%. If this stock were to get down around the 120 range, I will definitely start buying more heavily. Anything under $100 and I will absolutely start to load the boat with this stock. This is one stock I'd feel comfortable owning in any environment, regardless of whatever economic, political, or societal turmoil we might experience. I plan to build a solid position over the coming months and continue to invest and reinvest dividends over the long term. For long-term income or growth investors, I believe this is one of the best choices out there. The last stock I want to discuss is Visa Inc., ticker symbol V. In my opinion, this stock is the closest to fair value out of the 3, but also carries a little more risk. Visa and other financial services companies have tanked with the market in the last month, leaving Visa currently down over 36% from its highs, performing about in line with the market. These stocks have been hit harder due to their high exposure to cyclicality, but it isn't actually quite as bad as you might think. In a recession or depression scenario, many people may default on their credit card debt. But Visa doesn't actually make any money directly from the interest payments customers make on their cards. Their main revenue sources are services, data processing, and cross-border payments. They get paid based on total payment volume on Visa-branded cards, the total number of transactions their cards are used for, and cross-border payments and currency conversion. Essentially, they are a middleman, providing the payment infrastructure and brand for financial institutions and businesses to use. Every time someone pays with one of their cards in a store, they take a small fee off the top. Every time someone uses their cards to make a payment in another country or currency, they take a small fee off the top. Their revenues and profits would certainly take a big hit if general consumer spending slowed down significantly, but they themselves wouldn't be at risk if there were to be an uptick in defaults on credit cards, at least not directly. Visa has a current trailing PE of 24.78, with a forward 2020 PE of 22.55 and a 2021 PE of 19.2. So analysts are expecting them to put up some pretty reasonably good EPS growth over the next 2 years, and I would generally agree given their excellent historical performance. However, there is certainly a chance they could miss EPS estimates in a big way in 2020 given the current economic uncertainties. Like the other stocks on this list, Visa is also a pretty good dividend growth stock with a tiny current yield of about 0.8%. But a great growth history. Like Microsoft and Costco, they've grown the dividend every year since they started paying it in 2009, with an amazing compound annual growth rate of 24.81%. Obviously, that kind of growth rate isn't sustainable indefinitely, but given their tiny payout ratio of less than 22%, I think there's a good chance that they can continue to grow their dividend at a rate of 20+% over the next decade. If you bought at current levels, that would leave you with a 10-year yield on cost of over 5%. Not bad for a company of this premium quality. This is one I would truly class as an excellent growth stock, both from a dividend cash flow and a capital appreciation standpoint. I hope you enjoyed this video. Please keep in mind that everything I discuss today is my own personal opinion and doesn't constitute financial advice. I am long one of the stocks mentioned today, Microsoft, ticker symbol MSFT, and I do plan to start positions in the other two stocks discussed today at some point within the next few months. Don't forget to leave a like and comment if you enjoyed, and subscribe for more similar videos in the future. Thanks for watching. I will see you in the next video.